Yeah, I can hear you. I can hear you.
Oh, okay, that's good. Thanks for
Yeah, it's
organizing.
very soft, but I can hear you.
Oh, okay. But thanks
Yeah,
for organizing this session. Appreciate it.
yeah, no problem, no problem. Because I got a few requests, so I thought we can spend uh a session, right? So I could walk you through. Now, have you
Mhm.
traded for option before?
Not really, but I have learned Forex.
Yeah, so option you have never traded before, right?
Uh, saw some YouTube videos. Still not very familiar with it. And
Okay, give me 1 second. Let me try to put my earpiece because I hardly hear. Yeah, wait a second. Testing, testing. Can you hear me?
yes, can.
Okay, wait. It doesn't come to my earpiece. Okay. So we have okay, we have everybody in. We have Nick. Can you hear me, Nick?
叫你嚟啦，叫
We have Raymond. All right. We have JIP. We have one more person never come in. Oh, France. Okay. Okay, all present. Very good. Now, if you have a mic, the best is put on your mic so it'll be easier for you to ask questions, right? And so I can answer you, right? We try to make the session as not to drag too long, right? So now, let me start, right? Now the purpose of these sessions is to give you some knowledge, right, about option trading, but not everything about options because in MOT stand for my option trade. I only do buy call or buy put. Only buy call or buy put. By the way, can everybody hear me?
Yes.
Okay. Yes. How about the rest? Can all hear me? Okay, good.
Yes, okay.
All right. So for the past if you follow my option trade before, if yeah, and you know that I actually did some option selling as well, and also I do some spread trading, meaning that buy and sell at the same time, multiple legs, right? So it can come to quite complex, and also when we sell put options or we sell a call options, uh the original intention is you must be ready to take ownership of the share should you be assigned with the share, right? So most of the time I can see that most of the trader students, they sell a put, they sell mostly we sell put, we very seldom sell call, right? We sell a put. The thing is when the price drop to the level they are willing to take ownership, they agree to take ownership, they don't want to take ownership, they just want to speculate the profit. And I give you one example, right? Because since all of you are brand new, now if you don't understand or if I talk too fast, you let me know, then I repeat again, right? Now, when you are selling an option, you can sell a call option, you can sell a put options, right? So most of the time we sell a put option because we want to take the ownership of the share. So let's say example today, XBI, right? This is the ETF. Okay, let's look at something that you more familiar. USO put. USO is an oil company ETF, right? So if, of course, this one we put a long put, means we buy a put. When we selling a put, we say we short a put. Now, when we short a put, basically what we say is we want to own the share if the price drop to a certain price level, right? So now let's say example, I show you USO chart again. I'm not sure whether you can see or not. Okay, 1 second. Let me have a new share. Okay, new share. Now, can you see my chart?
Can.
Can, right? So this is USO, yeah? United Oil Fund. It's a ETF traded fund, right? So now it is trading at $71.34. Okay. So let's say that I think that this company is a good company. I want to own the company, but I am not willing to pay $71. But if the price, let's say, come down to, let's say, just example, random, yeah, $65. And then I said, okay, well, if the price come down to $65, I want to buy, right? I want to buy. But at $72 or $71, I'm not willing to buy because I like this company, but I'm not willing to pay at this price. I want to pay at the lower price if the price comes down, right? So with that in mind, the trader will sell a put at $65, right? So if the price eventually trade below $65, you will be assigned with the stock, right? Which means that your account must have the money to buy over the share, right? One share is $65. You just multiply $100, 100 share, right? So you can multiply. But the problem is most students, the account don't have that kind of money, but they want to earn the premium because when you sell a put, you are selling, maybe collecting, let's say, a $1 premium. So if they sell 5 contracts, you are making $500 immediately, right? So long as the price never trade below $65, right? Upon the option expire, you keep your $500 and you have no more responsibility. That is provided the share do not trade below $65, right? So you can make some winning, but there are times when market is move so fast and it just drop because of certain event, right? It dropped below $65 and you sell a put 5 contract, right? And you must come up with the money and in your account must have the money to buy over the share. $65 multiply 500 share. So that is the kind of money that you must have. And most of the time, the trader don't have that kind of money to buy. But they think that by selling a put, they don't think that the price will come down to $65, right? Because for $65 share price, if you sell 5 contract, which is 500 share, your account must have $32,500 US, right? And then you don't have. So what happened is they faster close the positions. So when they close the positions, they are losing money. They can end up paying. They have to come out. Maybe let's say example, yeah, $5. They have to come out example $5 to buy back the share to close their position. That originally they sell the put for only $1. So you can see that this contract alone, they already lost $4 per share. And now if $4 per share, if you multiply 500 share, immediately this person lost $2,000 because he doesn't want to hold a share. He just want to speculate that the price will not come below 65. So most of the time, the student can win many times, but he just need one time only, everything gone, right? So it becomes very, very risky, right? If you don't intend to own the share and you sell a put option, that become a very risky business, right? So I realized that, and I decided, okay, if that's the case, most student doesn't have that account size to sell a put, and they want to take risk. Chances are they're going to lose their account very soon, right? So for all my MOT trade, you realize that it's all about buying. Either we buy a call, or either we buy a put, right? So when we buy a call, or we buy a put. Okay. We don't do it. We don't deal with selling anymore, right? Selling because you must take ownership. Now, if you are not ready to take ownership, you tend to stand at your account tend to get whacked, right? So what is the advantage of buying different from selling? Now, when you are buying something, you need to pay a premium, right? And let's say you buy a call on USO, again, let's say example, right? And in this example, USO, right? Let's say example, you pay for, I just take example, yeah, it's not, let's say example, we pay for $2 to buy a call. And so why you buy a call? When you buy a call, you expect the price to go higher, right? That's why you buy a call. So let's say the price failed to move higher and it moved lower instead. It moved against you, right? So until the option period expire, this price still did not trade above your strike price. Means the price that you expect the price to trade above, but it did not trade above. So we call it strike price, right? So if that's the case, this trade end up as a losing trade. And the maximum loss that you're going to incur is $2, nothing else. So if you have $2 and let's say you have buy 100 share, one contract, right? One contract, 100 share. You lost $2 multiply 100. You lost maximum is $200. So at least it is you control the risk, right? Your maximum risk is the premium that you pay out. That is when you are dealing with buying an option. Now, buying a put is the opposite. If you expect the price to go lower, right? And you can buy a put and you expect if the price really go lower, you make the money. But let's say the price fail to go lower and it go opposite, go up. It means that you are losing trade, right? Because you buy the price go down, but instead the price go up, right? So what is your maximum risk? Let's say example for this particular example, you pay $1.80, right? To buy a put and it failed. So what's your risk? Your maximum risk is $1.80. Multiply the number of contracts. So if you again, let's say you buy one contract, which is equal to 100 shares. 100 multiply 180. That is your maximum risk, right? So therefore, you can see that when we are dealing with buying options, your risk is limited to the premium that you pay out. Nothing else. No more than the premium that you pay out. So far, is this clear? Is everybody okay on this?
Yes.
All right. So now the other thing is risk management, yeah? So just now we say that we deal with the premium here. So let's say you buy a call, right? You buy a call and you pick an option expire in 60 days. From the day you buy, that means that this option, you have the 60 days time period for the price to move above. Let's say you buy a call at just now we say the price 71. You buy a call at $75. So $75 is your strike price. So you buy a call at $75 for 60 days. So what you meant is within 60 days, you expect USO to trade above 75. So 75 we call strike price. So if the price trade above 75, you make the money, right? So, and then you have 60 days for this trade to work out. So at the beginning, let's say when you buy a call, at the beginning, the price might go down against you. So let's say $75 is here, right? This is your target. So when you buy, the price go down and you are losing, right? But let's say after 1 month, you see the price start going back up and your 60 days expire is here. This is your last day expire. So the price go up and the price can come down, the price can go up, the price can come down. As long as the price go above $75, your strike price, before the option expire, you still make money. So you have 60 days for this trade to play out. Initially, it can go against you. It doesn't matter. No matter how low it go, your maximum risk is only $2. So far, is that clear? So sometimes you see that when you buy an option, whether call or put, and the trade go against you, it is okay because if you have the time, right, then you should not be worried about oh, this is trade is going to be a losing trade, because you have the time for the price to work back again, right? So now, when we buy an option, just now we give the example, the $2, right? We pay $2 to buy a call option at the strike price of $75 for 60 days, right? For 60 days. Now, these $2 here, the components that make up a $2 have two components. One is the time value. One is the intrinsic value. So I do not want to, I don't need to explain about this because I don't want to confuse you. You just remember there are two components that make up this $2, right? So let's say that the time value is represent let's say 90 cents. If based on 60 days, right, your time value worth 90 cents. Now, as it go nearer to the expiry, let's say by the time the price, the time passed and you left 30 days, your time value will go down as well. Maybe you left about 45 cents. Example only, yeah? And you left, still have a 30 days to go, and you left about time value 45 cents. And if this trade, right, it is still trading below your $75 strike price, so your intrinsic value has zero value because it is below your strike price. If it go above $75 to $76, then your intrinsic value have $1 value. If you go to $80, example, your intrinsic value is $5. And if after 30 days, you close your trade, your total premium will be $5, which represent intrinsic value, plus the balance for 30 days, 45 cents. Your premium will be $5.45. And you bought it for $2. Your profit is $3.45 per contract. So if you buy one contract, you multiply 100. That will be your profit, right? It's 545 minus the $200. So your net will be 300 something. Everybody got it? Until here? So the premium over here represent intrinsic value and time value. The more time you have, the more value that come from this time value. Is that clear?
Yes.
Okay. So now let's say come to the risk management. All right. Let's say after 30 days, you still have balance 30 days to go before this option expire. And you see that this price already keep going down, keep going down, keep going down. You have no more intrinsic value. But you still have 30 days left, which represent 45 cents. And you based on the adjustment, you say, well, I don't think this USO can come back up above $75 for the in the next 30 days. And you want to cut loss. So you cut loss by closing your trade. So the moment you're closing your trade, of course, your interest value already got zero because it did not trade above 75. So it got zero over here. But when you close your trade, because you still have 30 days to expire, you still take back 45 cents. So end up that your loss is $2 that you pay out minus 45 cents. So your net loss is $1.55 per share. So multiply 100, that will be your maximum loss. Can we understand so far?
Yes.
How about the rest? Everybody okay? Okay, yeah, so far, yeah?
Yes.
All right, good. Okay, so may erase off. So far, and I mean, basically that's it you need to know, right? So so I repeat again, right? When you see like when you see this trade signal come out, long means to buy. Long a call means that you are bullish. You expect the price to go up, then you make money. If you say long a put, it means that you expect the future price to go down. If the price go down, you're making money. Of course, you have to go down below your strike price, right? So basically, in MOT, I only have these two. So make it very, very simple. And you know exactly what is your maximum risk for every single trade. You pay $1.50 to buy a put, and you buy one contract, which is represent 100 share, right? And if this trade doesn't work out and option expire, right, your maximum loss will be $1.50, no more than that. Multiply 100 share, which represent 150. Okay, so the beauty about long buy option, whether call or put, is you limit the risk, how much risk you want to take, right? And then you trade. Now, when it comes to money management, when to cut loss. Now, this is very personal, right? Now, there are two ways you can do it. Now, let's say that you buy an option, whether it's a call option or whether it's a put option, it doesn't matter. Let's say you pay $1.50 and you buy an option for 60 days, expire, right? And let's say the price, and you buy a call option, meaning to say that you expect the price to go up, right? But instead to go up, the price start going down, right? After you in the trade and the price start going down, and you see that price unlikely to no, you are not sure whether it will come back or not. But now, when you cut loss, one way is if you already determine that, okay, this is 60 days option, which means that the price might go down first, right? The 60 days, this vertical line, which is represent 60 days. From here, 0 days to 60 days, you got 2 months for this price to, let's say this is the strike price. You've got 2 months for this price to go back up. So long as you go up before 60 days, you make money, right? So you say, well, I want to let this trade play out. And you want to let the whole contract period play out, means 60 days, right? So after 60 days, if it doesn't work out, the price still trade below your strike price, then your maximum loss is 150. So basically, you say one method is you risk whatever you decide to trade, which is $150 per contract, 100 share. Now, the second method is you can determine by percentage. Now, let's say you pay for 150 to enter to buy the call for 60 days. And the trade doesn't go your way, and instead it go against you, right? And now you take a look at your premium. Your premium left about, don't have to be exact, your premium left about 80 cents. You pay 150. Now your premium left only about 80 cents, right? You know that you lost almost about 50% already. So at that point in time, you can decide, okay, well, since this trade already, my risk is only 50% of the premium I'm willing to trade. So if you realize that your premium only left 50%, you can go in and close your position. So at least you still take back 80 cents and you lost 70 cents. Right? So these are the two ways that you can manage your risk. Either you decide how much you let the trade play out. Once you put in 150, you let the trade play out for the next 60 days, right? If it doesn't work out, it doesn't work out. Your loss is 150. The other second method is you can decide, okay, I spent $1.50, but the moment the premium that left 50%, no need to be exact, I want out because you are 50% loss already. So you want out, right? So these are the two methods that you can manage your risk, right? Is that clear?
Yes.
Yeah. All right. So another one is how to know how much to trade, how many contracts to trade, right? Let's say just example, yeah, just example. You have your account size is, let's say you have $3,000 in your account. Just example. right? And what you can do is you can divide this 3,000 into 20 portion, 20 part. So 3,000 divided by 20, how much you get? 150, right? $150. That means that for every trade that you want to follow, right? You cannot trade more than 150. You guys follow me? That means that the premium that you pay out should be only about below 150. Any premium that any trade call that I make that is above 150, it is beyond your risk. Then you should not trade. Right? So you divide your 3,000 into 20 times 20 opportunity. Right? So you take this is one time. Let's say one time you make money. You make. Second time you make money. Right? The third trade that you have, you still risk 150. You make money. The fourth trade you left, you lost money. Right? After you go on, finish, after 20 trade, you tally up. Let's say you already make, let's say example, $1,000. So now your capital is 4,000. 4,000 divide again 20 trade. All right. 4,000 divide 20 trade. This time per trade allocations is $200. That means you can take trade that is premium not more than $2. Can you follow me so far? Right. Now, why 20 trade? Because 20 trade means that you have opportunity to the higher this number, the more your account can survive. Right. So that's how you're going to manage a system for you to manage to do this trading. You must have a system. You cannot say, today I I put in 2 contracts, which is $400. I feel very confident. So I want to risk $400 for this trade. Next trade come out, I want to risk $200. Next trade come out, I want to risk $300. The fourth trade come out, I want to risk $450. Then there is no system. Can you see that? Every trade, your risk is not even. Right? So this is how you can do, right? So you can say, okay, well, if you have $4,000 in your account and you divide into 20 times, so each opportunity, you maximum loss is $200. Right? You allocate $200 as your maximum loss. Again, there are 2 ways to manage this $200. One way is you can risk the $200 or 100% until the option expires. Now, second method is the moment your $200 become $100, which is 50%, you cut loss and take back your $100. So your loss is $100. You follow me so far? So this is a system very easy to follow, right? And once you finish 20 trade, finish already, you come back again, calculate how much capital you have, and you divide again. Okay? Any question?
Benny, meaning to say that we run 20 trades at one go, or how many trades are we running?
Come again?
How many trades are we running? If let's say $4,000, right? So I can basically do 20 trades. So
Yeah.
like, am I able to run like 10 trades at one go?
It depends on the premium. Okay, let me show you. Let me show you this one. Let me show you this. Can you see my trade alert?
Yes.
Can you see my trade alert?
Yes.
Can, right? So let's take a look at this example, this one, OSTK. So OSTK, you can see that what is the premium? 143 cents. All right. The strike price is 17.50. So which means that if you buy, you see, this is a buy a long haul. You expect this to go up, right? And you pay one contract $1.43, which is equivalent to 100 share. And let's say example, based on $4,000 divided by 20 trade, you can risk up to $200, right? Right, and then you can see that, okay, well, I can, if I trade one contract, I risk, if it doesn't work out, it's 143. So if I buy 2 contracts, which should be 286. 286, right? Correct or not? My math is correct, right? And your risk management, you can say, okay, well, I'm going to buy 2 contracts, which represent 200 shares. If this trade doesn't work out and the price dropped to 50%, which means that it dropped to $1.43, it dropped to about 80 cents. I cut loss. So when you cut loss, you take back 50%, about 50%, no need to be exact. So your loss is 286 divided by 2, 143. So you are still within this $200 that you assign. Can you follow me?
Yes.
Yeah. So how many contracts you can buy, it all depends on how much you allocate and what is the premium price. Okay, so let's take a look at another example, right? Let's say we have this one example. Oh, this $5.10 definitely is out of your budget. Then this trade you should not take, unless you have a bigger budget. Then that's a different story. Follow, right? So then then we look for another trade. I'm not sure this one. This is 80 cents. Okay. So for this particular trade, we have 80 cents. And we buy a call, long call, buy a call, which means that we are bullish on this particular trade, AAOI, expire on 18th of August. All right. The strike price is $10. Okay. So which means that as long as within we have expired, this trade was posted in July, expiry in August, we have about less than 1 month. That this particular trade less than 1 month, and it only worth 80 cent premium. So if you have $200 for you allocate 200 for every trade, you can straight away, you know that how many contracts you can buy. You can buy maybe 3 contracts. And 3 contracts will give you 240, right? And then you can tell, okay, well, 240 I put out, but if the trade doesn't work out, I'm not going to risk all the 240. Maybe say I'm willing to risk up to maybe 80% of the 240. So I'm within the $200 that I assigned. Or you want the risk total, up to you, because it's $40 different. Can everybody follow me? That's how you decide how many contracts you can buy. So with a system like this, you will not say, because if you don't have a system like this, today this premium is 80 cents, right? And then you come to the next trade. Next trade is, let's say we have this one, SO. Premium $2, right? Still low. Take by another one. TSM. Premium $4.40. One contract you already have to, if it doesn't work out, it's 440 cents, right? So this is way too much for you. But if you don't have a system like this and you take every single trade, so some trade you risk a lot, some trade you risk too little, and you have no idea how much actually you risk, because your participation in every trade, the risk will be different. All right? MOS, $1.65. Well, you can try for 1 contract. Can you see that? And the duration, you can see that based on the past 3 months, right? Duration usually is very short. 2 days. We seldom have a trade that we hold more than a week. Sometimes we do, but I say seldom, right? You can see that 2 days, 6 days, 5 days, 7 days, 15 days, 8 days, 11 days. Very short, right? That's all the result, of course, and the ROI, right? Okay, example, this one. 100% loss. Let's take a look at this. AMD. 100% loss. It sounds a lot, right? But the price, the premium we pay out is only 160. So if 100% loss, it means that if one contract I lost $160. That's it. That's 100% loss. I lost all the premium. All right. So and then when you take a look at another trade, let's say example, another loss trade, Snap. 35 cents, 100% loss. Right? It looks a lot, 100% loss, but every contract is only 35 cents. Multiply 100 share is only $35. Is it $35? Correct, huh? Right? So how much you can buy, how many contracts you can buy, it all depends on the premium price and how much your allocation per trade. Right? And we want a system, you want to have a system to make sure that every trade that you take part, the risk is more or like even. You will not be exactly the same, but more or less about that. You don't want, today I take a trade there is 35 cents, and tomorrow I take a trade, let's say example, it is $1.60, still all right. And let's say you take another trade, gold, $3.95. From 35 cents for $1.60 to $3.95. This is a lot of difference. And if you take the trade on gold, you realize that you risk more on GLD than compared to other trade. And if this trade doesn't work out, they're going to burn a big hole in your account, right? So you need to have a system. Can everybody follow me so far?
Yes, can.
Can, huh? All right. So basically, that's it, right? That's you can see that when you come to my subscribe to my, you will receive something like this. This is through apps, right? You push it to you. You will receive say you have a new trade, right? And then you will either go and log in, open out your apps in your handphone, and you see all this information, right? Let me go through this. The trade is a long call, means you buy a call. You expect the price to be bullish, to go up, right? Long call. Buy BTO is buy to open. This one it's not important. Not really necessary. You don't need to know. Ticker symbol, of course, you need to know. GLD is a ticker symbol. Right? This is a gold ETF. What is the limit price? I mean, this is a premium that you pay out, right? When is this contract expire? December 15th. When this contract posted? October 16th. So more or less you have about 1.5 1 month, 2 months, right? October 16th to December. So this option is about 2 months. Okay, before expire. In other words, you have 2 months for this trade to work out in your favor, right? Of course, the strike price. You must know the strike price. 180 is the strike price, right? And then of course, this one is you will not know this until we close the trade. This will not this until we close the trade. This one you do not know until the trade close, right? So these are the information you will receive. A long call, what ticker symbol, what is the price you pay, when it expire, and what is the strike price. Okay, so the important are these: 1, 2, 3, 4, 5. These 5 information are important to you. The rest is not important to you. This one come after the trade close. Come after the trade close. Come after the trade close. Right? So these 5 information. And if you understand this, you can already go to your platform and put in your trade. All right? Question? Any question?
Benny, how do we know when we should close the trade? Let's say for this case, it's 180 strike price. Like how much should we close the trade?
It depends on the premium. That's just how I already mentioned. Let's say example, this is $3.95, the premium that you pay out. So let's say you buy one contract, which means that if you let this trade play out until the end, your total loss will be $395. Either you decide to risk all for the next 2 months or next 60 days, you want to see this price go up. Initially, it might go down, but as long as within 60 days, go up above the strike price, $180. Let's say this $180, and this is the expire, you still make money, right? So you can decide. This one you have to decide. I can't tell you because everybody are different, right? You can decide you want to risk or you say, okay, if this one the premium, I want to cut loss when the premium drop to 50%. So how do you know it's 50%? When you have an open trade and you try to attempt to close the trade, but you do not close it, you don't send in the order, you just say close the trade. It will show you, oh, now if you close the trade, your premium left, let's say example, $2.10. Then you decide, okay, I lost about 50% already. Okay, let's close the trade. So you close the trade, so your loss is about $200 for this trade. You got it? So you decide, you don't look at the strike price, you look at the premium. Follow me?
So the premium will adjust from time to time, right?
Yes. I will go to the platform later to show you. The premium,
Okay.
the broker will, this one they will adjust by itself. After this, we'll go to the platform. But so far, any question of what I've just mentioned, is it clear? The
Yes.
important things that you need to take note is when you cut loss, right? There are only two ways. Either you risk all, example, let's say, okay, $3.95 is too much for me. So this trade, you don't take part. Let's say MU, $3.90 is too much for you. You don't take trade. Done. 180, okay, I can take 180 is within my budget. That's an example, yeah? Within your budget. Okay, I want to buy one contract put. All right. So one contract put, maximum risk, if it doesn't work out, is $180. And the duration you get in is October 14, expire November 17, which is about 30 days. So for this trade, it has 30 days to work out. Then I say, okay, well, 180, and one of your decision is, I want to risk this amount for the next 30 days, that this trade should go down. If it doesn't go down, your maximum loss is 180. So you decide, before you even start trading, you must have already a decision made. Should I risk all, or should I take partial 50% cut off? Now, 50% is just a number I give you. But you can say, okay, I want to be 40%. And some might say, I want to be at 70%. Up to you. This is entirely up to you. I just anyhow just get the 50%, the middle line. That's all. You got it?
Yes.
Everybody all okay?
Yes.
So so we cover about the stop loss, when to get out from the trade, right? This one is clear. Now the other problem which also become a challenge is when to take profit. When to take profit also got problem, you know. You see, ROI 155%. All right. Sometimes if we buy this to go down, it's a long put, right? And the strike price is 47. So the price must be going like something like this. And this is 47. And this is option expire at this vertical line, right? So you buy a put and you expect the price to trade below $47 within the next 30 days, right? So price come down and you go down like this. You already make money before expire this vertical line. Now, you can already choose to go in and close the trade, take a profit and a peace of mind. But sometimes you see the price, it go up, it continue to go down and go down and go down. You feel heart pain because you left too much money on the table, right? Then for this particular trade, you say, wow, I left too much I left too much money on the table. I should have picked up a lot more. I get out too early. But it can go the other way, right? When the price come here, it can go down. Before expire, the price can go up. Just by 1 cent above $47, you lose the trade. So instead of making money like this, you end up loss, because we will never know exactly when the price will go down, go up, right? So taking profit become a problem, because sometimes people say I should have taken more. Why I take trade too early? My advice is, if your account is small, and most of us start with small account, right? Take consistent profit. You don't have to go for this ROI. If you can get about 30%, get about 30%, 40%. Sometimes if you just, like you can see here, 49%, 33%, 39%, take your profit. Why? For 33%, this one with duration 2 days. In 2 days in a trade, you already make 33% ROI. What kind of business can give you 33% in 2 days? Take your profit and go and have a peace of mind and wait for another opportunity, right? So this is always my advice, right? Whenever you can make money, right? And you can see that, well, example, yeah. Let's say you buy and you expect price to go up, right? And the price come to, this is a swing high, and the price already coming near the swing high. You look at the chart, oh, the price already coming to the swing high. This might pose as a strong resistance. The price might have difficulties to go through, right? So at this point in time, you might say, okay, well, I want to take my profit and go. So this is something, a guideline. Look at the chart, right? Because example, you have this DVN, a long call. And long call, let's say we have something like this, right? The price go up and go up, and this is your strike price, and you are already making money before this vertical line option expire. You already making money, and you look at the chart, the price is coming into this strong supply. It's going to have difficult time for the price to go through, right? The price might just come up and reject, come up, reject, and it might reject altogether if it fail to go through, right? So you can say, okay, well, since the price already approaching a strong resistance and I'm already making money, I want out. You follow me? It is never wrong to take profit, all right? The example, this one, $88, 88% in 3 days. In 3 days, your ROI, return on investment, is 88%. That's a lot. Why should you aim for triple digit, right? Because sometimes we see that we have triple digit, yes, in 8 days, right? 8 days, within like a week, ROI 160%. But this is not something that you need to look to achieve, right? This one 13%. 1 day, right? After the price go up in the trade and it come to a strong resistance, I find it difficult for the price to go through. I decide let's take our profit. For 1 day in the trade, I make 13%. Not too bad. 1 day, not 1 month. Only 1 day, I make 13%. All right. If you run a business, you understand this is a lot of money, right? But people sometimes don't understand all these ROI things, right? But if you can consistently make profit like this, now look at this, 22% in 1 day, 24% in 5 days, 20% in 1 day. If I can make 20% in 1 day, why should I continue to hold on the trade? Because especially it comes to a strong resistance or strong support that potentially for price difficult to go through, I better take my profit. All right. So how much, when you take a profit, it all depends. You can look at the chart as a reference, right? Decide for yourself. You don't have to aim for triple digit. What you want is this kind of consistent double digit, right? Single digit sometimes is also okay. Doesn't matter. As long, why single digit? Because the price already tried, but fail to get through, then I decide to close my trade. I don't want to end up as a winning trade, become a losing trade. I don't want that, right? So I close my trade. And you can see the majority of it. This is what you want. Aim for double digit, but consistent winning. Consistent winning. Do we have losses? Yes, we have losses. But this loss, example, $1.20. How much loss? $1.20. Even though we say 100%, but that's $1.20. All right. XLV. Another 100% loss. This one. PayPal. This one a bit more, $2.41, which is $240. All right, 100% loss. Okay. But if this is within your risk management, it is okay. You must accept, right? The most important thing is you can see that if you aim for double-digit win, majority of the trade that we have here are winner. See? Majority are winner. Two losses, three losses, break even, four losses, five losses, right? That's for month of October and July. Okay, you follow me, right? So what you do is when you decide to follow my trade, right? For those trade you follow, make consistent profit. Aim for double. Don't aim for triple digit. When you see people making triple digit, it's okay. Let be happy because for these people to make triple digit, they might also have a lot of losing trade, right? Before they have triple digit. So you don't have to aim for this. When you have grow your account, right? You can start looking for this. But at the beginning stage, go for double digit profit. Consistent profit is more important than triple digit. Yeah. So if that's okay, what I want to do next is I want to show you the platform, right? Is that okay?
Yes.
Question?
Yes.
Okay, let's go to the platform. Now, can you see the platform Tastywork?
Yes.
Okay. Now, in Singapore, you can open account with some local broker like Tiger. I think like Tiger also have, right? I think Tiger, right? But I think they are offering CFD, not 100% option, and I'm not sure whether they offer all the US stock. Maybe they only select a few and then offer, because if they want to offer everything, they have to pay a lot of money to the US side, right? So sometimes the broker, in order to cut costs, they don't offer. They select a few counter. They don't offer everything. You can open account with Saxo. Also can, again, same thing. They don't offer every US company, right? They selectively offer, right? Now, Tastywork is a US company. The owner is last time the owner, the Thinkorswim. You heard of Thinkorswim, right? It's a very big company, very good company. They sold it to TD MetaTrader, and this owner come out and start another company called Tasty Trade, right? Their commission is reasonably low, right? So I like that, and they also give free data, market data, right? Now the other broker that you can consider is Interactive Broker. Interactive Broker, they charge even a very low commission per trade, but the problem is they don't provide data. Now, what data I'm talking about is let's say I want to trade. I want to trade for December 15 option expire. So I click, and the counter I want to trade is SPY, right? So SPY now is trading at 449. 449 is here, right? So if I'm bullish, I expect the price to go higher. Let's say I want to buy a call at the strike price of $152. So I look at this column, strike price, right? The strike. So I'm going to buy a call. The call is on the left side. These are all the call. This is put. The right side is put. The left side is call. Every broker, they're all the same, right? So if I'm bullish, I want to buy a call, and now the current price is trading at 449, right? I want to buy a call $3 above the current price, 452. How much premium do I have to pay? Well, the bid price and the ask price. So you want to buy, I need to pay $5.36 for every contract, right? So the open interest, the volume basically tells you how many people are participating, right? The out of the money percentage, what is the probability that this trade will fail? 54%. It means that within the next, how many days? This one is 29 days from today. if I buy a call option that expire on 15 December, I have 29 days before this option expires. For next 29 days, what is the probability that the SPY will not trade above 452? This is a percentage, right? But anyway, we don't look at all this. All right. So when you follow my trade alert, you just, okay, I say that, I give one example. Let's say I give an example. Let's take example, one of the trade that I recently post, right? Example, let's see, where is it? Recently, yesterday is one. Let's take a trade that I post yesterday. Can you see my my trade call again? Can you see my trade, my option trade? Yes, no?
Yes.
Okay. So let's take this trade, which I shared last night, right? Long call. Right? Long call. Option type is long call. Okay, long call. The company ticker symbol is AI. Expire January 19 next year. Strike price 35. Limit premium that payout is $2.25. Right? So let's go and see this pair AI. AI, I go to the chart. I key in AI. Sorry, I don't go to the chart. I go to the option, the broker platform. Sorry. I want to show you that. Go to the broker platform. Can you see the broker platform now? Can you see the tasty work now?
Yes.
Yes, yes.
Okay. So I key in here AI. Right? On the top left corner, AI. Then I click. So option expire is January 19. So this is option, right? Option expire. These are all the option expire January 19. So which is this one. I click this arrow drop. So these are all the strike price. So the strike price just now was how much? Is it 35? I forgot. How much was it? Do you remember? I showed you just
Yes,
now the strike price. 35, right?
Yes.
Okay, 35. So where's $35? So you can see $35 is this one. So I buy a call, right? So we look at the left side. The right side is put. You look at the right side for the premium, how much you need to pay, right? So for buy a call is this premium. Okay, so $2.11. So yesterday I post a trade, we enter about $2.20. So now basically this trade is not moving, right? It's $2. But remember, you might say, okay, it's not making money. But remember, we have how many days? We have 64 days for this trade to play out. We have plenty of time, right? So initially it might not look good, but remember we got 64 days. That's 2 months for the price to go up, right? So option in a way is very relaxed because it's unlike Forex that it is really win or lose is almost like immediate, right? Option is we have time for the price for the trade to play out. Sometimes initially price might not work, but given that we have 64 days for the price, now can the price this counter right now is trading at $29.60 to $35 is about $5.40. Right? Now based on this IV, you can see here until 19 January, this pair can potentially move by $6.50. And we need to move by $5.40. So we still have a margin of $1 margin, right? So it is safe, right? So of course, all these numbers will keep changing. All these premium number will change, right? So sometimes when you want to follow a trade, you open the option chain. Okay, expire January 19, right? Strike price 35. What's the price right now? The price right now is $29.30. You look at this column here, the IV. From now until this date, 19 January, which is 64 days, this pair can potentially move $6.50. $29.30 to $35 is only $5.30, right? Or $5.50 example. It can reach there, right? It can reach there. Okay. Then okay, well, this within then you can take the trade if you like to, right? And this is the premium. Okay. So, and if you want to take this trade and you just, if you are using every broker, how they enter the trade will be different, right? You can, when you open, decide which broker to open, you have to learn, go to the website and learn, right? So example, if this, I use Tastywork and the option is January 19, you just click this arrow. What's the strike price? 35, right? Long call. Now, if you click one more time, it become long put, right? Long call, if you click one more time, it becomes a short put, right? So make sure that you always put long call. You can only change this one, long call or long put, right? So this is long call, you put long call. Then after that, click go. Once you click go, you can see that this is something that you can move around. You can drop this to $35. This is your strike price, right? And then after that, once everything finished, you just click review and send. That's it. Okay, it's very easy to execute the order. All right, that's all. This was the option platform. But of course, different platform will be different. Okay, any question?
So Benny, if let's say yesterday I missed the trade when you post, right? Then is premium is at 225 and now premium is at 211.
Yeah, you still can enter. If you within the still not, it doesn't move that much, you still can enter. Yeah,
okay.
You see, the good thing about option is when I post a trade, right? It doesn't mean that you missed a trade last night. It doesn't mean that you missed a trade because the premium might go down, right? Like as I say, right? This trade, we expect the price to go higher. So let me show you the chart of this. Can you see the chart?
Yes.
Okay, this is AI, weekly time frame, right? So $35 strike is here. The expiration is 19 January, which is wait, okay, I changed this to daily. Weekly is a bit difficult. So this one here. This is the expire. Okay. So the current price is here. I have more than 2 months for this price to move above 35. And is it bullish? Well, I think if this is bullish, unless the price already start going down, then no chance. But if this is moving higher, I got 2 months, as long as it trade above 35 before this cutoff date, 19 January next year, I make money. That's it, full stop, right? So you can always enter because if you miss the trade, you are busy, you attend something and you miss the trade, yes, last night, but today the trade go down here. And now you can buy even at lower price, right? You can buy even at lower premium and then expect price to go higher, right? So you never say that you will miss the trade unless sometimes, of course, you miss the trade and the price already go up higher and you do not want to chase after the price anymore, right? But the price go higher, it might come back down and go up again, right? So when it come back down, you can go in, even though that is maybe a few days later, you still can go in, right? Because the market is always moving like this way. So option trading, you don't say that I missed the trade, means I cannot take this trade anymore. No, you still can. All right. So long as the premium is still not, it doesn't move away very far, it still can. What Malaysia? Nick, what do you mean Malaysia?
No, how about Malaysian can open the tasty?
Oh yeah, tasty work can. Only Filipino. They don't open they don't open. Any Filipino here? No, right? Okay. Any other question? Very straightforward, right? Very easy. Now, if you follow the trade, now you don't be greedy initially. I always suggest that grow your account first, right? Once you can double your account, right, then you want to say, okay, I want to aim for higher ROI. Okay, so initially always take consistent for small profit. Doesn't matter. Important thing is consistent for small profit. And our duration of our trade usually is less average. I don't say everything is less than 1 week. Sometimes as short as 1 day, you can take profit already, right? Example, we have another trade. I'm not sure whether making money. Let's think about another one is what is that? XBI. XBI. Let me see. XBI. Let me share with you. New share. New share. Okay. So this is another trade that I post. XBI is an ETF, long call. Okay. Pay for $1.72. Expire December 15. Strike price $72. Oh, sorry, this one already closed. 43% ROI. Only how long? 1 day. Can you see that? I post on the 14th December or November, on 15, which is yesterday, last night. Just 1 day, we already made 43%. Now you can keep the trade and continue let it go, or you can take profit. It's just 1 day. How are you going to make? What kind of business can make 43% in 1 day ROI? Right. This is XBI. Right. Let's take a look at the chart. XBI. XBI. Okay. XBI. Can you see the chart? XBI.
Yes.
Last night, you see the price go up to this high, which is 73.28 You close the trade. If you don't close the trade, what happened? We enter on this day. This day. Yesterday, it went up. Make 40% ROI in just 1 day. If you don't take the trade, the price go down. Now it's trading at 71. So if you have open position, now you are in a triple loss. It doesn't mean that you will not go up. It may just go up and come down, right? We don't know because we have until 15 December to work on for this trade. Right? So taking profit, like I say, it is always never wrong to take profit. If you can in such a short time and make double-digit profit, just take, because the price can just go down. And once, if you already take the trade, right, you have no more worry about this trade anymore. And people who are aiming for triple digit, let's say example to this high, now they got this is always at the back of their mind. What happened to this trade? What happened to this trade? You know? Yeah. Okay. I think that's it. All I need to share for this session. Any questions? Any other question you want to ask before we end the session? Is that clear, everyone?
Yes.
Okay, good.
So for taking profit, they do not like Forex, they touch this, they straight away close the trade.
You can set in your broker platform. Example, you want to close the trade, right? And let's say example, you enter the trade, the premium, let's say example, this premium is XBI. We enter at 172, the premium. Okay. $1.72. And you can go to your so once your trade open already, right? You can open another order. You see, close the order at $2.40, which means that you double your premium payout. You want to close the position. So you put your order there, and once the trade go up and you get premium is already touched your 240, your trade will be closed. You got it?
Okay, okay. Sorry.
So it's just like when you have an open trade, you just right click again, close the trade, and you can set your premium at what price you want to close the trade. So as long as let's say you set your premium to close at 240, right? And you pay at 172. And so long as the premium did not trade above 240, this trade will not close. But once the price go up, and the premium go up to 250, example, your trade will be closed and you make your money. So that's how we set the target. Stop loss also the same thing. Let's say, example, you pay out 172 and say, I want to risk 50%. If the premium drop to 50%, I want out. So after your trade open already, you right click that open trade position, right click, put your cursor there, right click, and you say close, right click, and then you close, right? And then you don't just close and send the order. Once you click close, there's a column that you can adjust your premium. So you adjust your premium to 80 cents. That means that when the premium drop to 80 cents, this trade will close. So this become your stop loss. You got it?
Got it.
When you open a trade and you don't understand how to do it, let me know. Then we can do a Zoom. Then I'll show you. All right. Okay. Any more questions before I call the session off?
Benny.
Yep.
Regarding to this trade, XBI, if let's say you on the day itself you close because you have already 43% ROI.
Yeah.
And if let's say this trade is projected to be a month, 30 days.
Yeah.
So once you close the trade, do you go in again?
Do you what again? Do you what again?
I mean, do you go in again for the second?
No. Once you close the trade, you are done. Why you want to go in again?
Oh, because I mean, it's only one day, right? Then it might go up again. So
okay, I mean, if usually when I close the trade, I move on. I don't want to. I don't look back again unless I because if you see, if the price go up like this, right? When the price go up and you say, okay, I want to close my trade when the price comes to this top resistance, right? If the price come back again, of course, if you want, you can go in again and the price go up. You can do that, but to me, it's very lazy. I have to come in, keep monitoring the trade. To me, if I close the trade, I close the trade. I don't look back again. But it's a good idea, huh? What you say here, we can, as long as it doesn't hit the target.
Yeah. Okay.
You can. Yeah.
Yeah. Thanks.
Yeah. Sometimes the price like this, right? It go up. After go up, you say, okay, I already made 43%. I want to take my profit. Just like this one. Yesterday, when the price was here, it was a bullish candle. Until here. Right? I decide, okay, close the trade. 43% in one day, close the trade. Because if not, right, we are not sure the price will continue to run or not. We are not sure. Because the price might come back down and then go back up, and you have to go through all these torture, mental torture. Right.
So Penny, we also need every day to look into the chart to decide when to take profit.
You don't have to. You see, you are not going to trade every trade that I post, right? But due to your limited capital and due to the premium that you need to pay out, right? You're not going to trade every time. So you decide what is your parameter, right? So the trade that come within your risk, you take the trade, right? Now, do you have to look at the chart when to take profit? I suggest you do it, right? Because you can go to stockchart.com or another platform called, what is that? Finviz, finviz.com, FINVIZ, stockchart.com or Finviz. FINVIZ. All these platforms, they give you free chart. Or go to TradingView, like what I'm showing you right now. All this you can get free charts, right? You don't have, you just register account, you get free charts. And look at free chart, you say, okay, well, if let's say example, we just take example, okay, then you have a trade here, right? You have a trade there, and the price is here. And this is your strike price. And you see the price is moving up to here. And you're already making money, right? And we still have maybe 30 days before option expire. And you look at this resistance, it's a strong resistance, right? Can the price cut through? Maybe, maybe not. If you fail to cut through, you're going to expect the price to pull back. Then you say, okay, well, I want to take profit. So it's always good that you can have a chart, take a look, right? Or not? Have I come to the resistance, right? Otherwise, how are you going to decide when you're going to take profit? You can also decide when to take profit is by setting your own target. Example, if you pay $1.80, and you say, okay, if I can make 50%, which is the premium become $2.50, I take my profit. So without looking at the chart, I mean, if you can't access to the chart, you can do that, right? I already make 50% now. I take my profit. All right. So it all depends on you. At what percentage you want to take a profit. All right. So, all right. Okay. Is that okay? See, this one we are long. Yeah. ELT. Okay. All right. Any question? Hello?
Benny,
Yep.
the subscription for the $70, is it still on?
No more. End already.
Okay, thank you.
Yeah. All right, guys. Thank you. If any question, you just let me know. Okay.
Thanks, Benny.
Okay,
Thank you,
welcome.
Benny. Thank
Bye.
you. Bye.
Bye.
Thank you, Penny.
Okay.
Thank you.